Good morning and welcome to the Killik and Co market update. Markets have been a bit unsettled this week thanks to the passing of Trump's so-called Big Beautiful Bill. The bill was passed by the House of Representatives by a very slim margin of 215 to 214. The bill extends many of the tax cuts that were introduced in Trump's first presidential term, and it also introduces further tax cuts and more spending. In particular, Trump wants to spend more on border security between the US and Mexico and more on defense more broadly. The bill still needs to be approved by the Senate, but the initial market reaction has been broadly negative. A key concern is the amount of additional national debt that the US would have to take on. Here's how the debt has grown over the last 20 years. You can see there was a bit of a jump in 2008 due to the financial crisis, and another one in 2020 due to COVID. Estimates suggest that the new bill could add over $3 trillion of additional debt over the next decade. The more debt a country has, the more interest investors will require in order to lend that country money. We therefore saw a rise in US government bond yields this week. Here's the yield on US 30-year government bonds. It rose above 5% this week. Credit rating agency Moody's has recently downgraded its rating on US debt because of concerns about the country's overall level of debt. That said, the new rating is just below the gold standard of AAA, showing that Moody's still believes US debt to be high quality and low risk. Equity markets weakened a bit when the bill was passed. Here's the percentage change in the S&P 500 index this year to date. The pink line shows the starting point. Last week we mentioned that the index had moved into positive territory on a year-to-date basis, but this week it has dropped below that line again. The prices of alternative assets have risen this week as equities and bonds have fallen, suggesting that some investors are looking for alternative homes for their money. Here's the gold price over the last 12 months. It rose in the first quarter of this year due to concerns about the tariffs. It dropped when the 90-day tariff pause was announced, and it's risen again this week following the passing of the new bill. We've also seen Bitcoin rising to a new record high of 111,000 this week. Some investors may have moved out of equities and into Bitcoin, but a more likely reason is a rumor of a further relaxation of the rules in the US regarding cryptocurrencies. It's worth noting that the US regulator is already much more relaxed than the UK regulator when it comes to cryptocurrencies. At the moment, the UK regulations do not permit retail investors to buy cryptocurrencies or investments relating to cryptocurrencies through a regulated investment company such as Killik & Co. And lastly, the latest UK inflation figures were a bit of a disappointment, showing a rise to 3.5%, which is far above the target of 2%. Here's a 5-year chart for UK inflation. That pink bar at the end shows the latest figure. It's significantly above the figure for the previous month. Some of this will be due to the additional costs that were imposed on employers by the autumn budget, particularly the higher minimum wage and the additional employer national insurance contributions. Here's what contributed to the latest inflation figure. Housing and household services was the biggest contributor to the overall figure rising, and transport and recreation and culture also pushed that figure up. Clothing and footwear had a negative impact on the latest inflation figure. This chart shows UK inflation over the last 5 years, illustrated by the black dashed line, and then the pink line shows goods inflation and the green line shows services inflation. You can see on here that the goods inflation has been much more volatile, but both have ticked up over the last month. Moving on to have a look at next week's calendar, we've got results due out from Nvidia, Salesforce and Costco. That's it from us. Have a great weekend, and we'll see you next Friday.